To kick things off here, again, I'm Jonathan with IVolLive. Thank you, everybody, for joining us on these Tuesday sessions. We tend to do a deep dive into a particular tool or topic for iVolatility. If you're brand new, and I know some are, iVolatility is, imagine it like an engine that can help power your options trading. So it's a great data and analytical tool that you can then use to put together actionable trades. So I've been an options trader for over 10 years, and I use iVolatility almost exclusively as my research and analytical platform to help me decide on which trades to actually execute. That's what it's all about, making money from options. So today, what I'd like to do is do charts part 3. I know some people weren't able to make charts part 1 and 2, so I'll do a brief recap of those two, and then what we'll do is we'll package all 3 videos together and email them to everybody who's here live as a thank you treat for joining us live. We try to cover things kind of in the live sessions we don't do in our emails or recordings, so that way anybody that takes the time out of their busy schedule to join us on these can get something a little bit extra. So anyways, again, welcome to the few that just joined. I'm going to kick things off and get going here. So here's our screen. We've recently added an API feature. So, for those traders that are interested in maybe getting some data via API, feel free to reach out to us and learn a little bit more about that. But today, what we're going to focus on is IVolLive. So again, when you register for IVolLive, if you haven't, we'll make sure to send out a link so everybody here is able to register for IVolLive. But the first thing you'll do when you join us is you'll come into your dashboard. This should be familiar if you've logged in so far. You're greeted by our friendly concierge who's going to show you the different shortcuts to our different tools. Today, we're going to spend most of our time within IVolLive, and then I'm going to show a little bit of the P&L calculator, how to take a trade that we get, a potential trade we get from the charts and run it through the P&L. So one moment, we have a few more. Again, these are busy Tuesday sessions, so welcome from the waiting room. This is Jonathan with IVolLive. We are live here on charts part 3. So again, the goal today is to highlight the different things that's available to you from our charting views. I'm going to show some things I like to do, some hacks, some tricks, and then plug a trade into the P&L calc at the end. And then again, we'll send out a recording with all 3 parts, charts part 1, 2, and 3 later today. So moving right along, here are, again, just different shortcuts to get to the various important tools within IVolLive. So for anything you need, whether it's related to charts or anything else IVolLive related, we're at support@ivolatility.com. I'll put that in the chat box later, before we wrap, so that way everybody has it. So here we are. This is another important button. That's why we have it flashing. Join our free IVolLive webinar. So this is what we do every Tuesday. You just click on that button and it will take you to a registration link. We do have limited seating, so that way we make sure that these don't get overwhelming and we can give everybody that white glove service. So it is important to register in advance. And again, I'm sure you've found this link because you're here today. But that's an easy shortcut to get there. So now charts. What do we, what's the point behind charts? Well, charts help us time and evaluate trades. And so to time and evaluate trade, of course, you need something to look at and evaluate. So some of the ways that I've shown in charts part 1 and 2 is kind of how to skim through our latest news feed, which is here, and find interesting, actionable ideas. Also, over here, we have in our news and research tab, where we put out our editorial. So in our editorial, these are always really good places to come to find interesting ideas. We kind of recap what's been going on in the market. In this case, we were talking about inflation and how that impacts the tech and the energy sector. Tech is something we've been writing a lot about, and we'll use Apple in our examples today. And then, we go through and we show how to use the IVolLive tools to analyze potential trades, and our conclusion down here was Exxon and Chevron are looking rather interesting. So this is another really good place to get news. You also see different updates that we put out within IVolatility. So you can see this is the Data Cloud API product that I was mentioning earlier. If that's of interest, we can we'll send out some more information on that. But this is where you find again, one or two always interesting actionable ideas. We'll focus on Apple today because that's one that we've used a lot in charts part 1 and charts part 2. So to access charts, there's a couple different ways to go about it. My favorite is to go through this IVolLive button here. The first chart I pull up every morning in my trading session, coffee in hand, is the VIX. The VIX is very important, and what's unique about IVolLive is that we have the ability to measure the implied volatility of the VIX. So I showed this in charts part 1. My favorite is this 1-year view. And what we're looking at here, our legend is we have price in blue, and then we have implied volatility in green, and we have historical volatility in orange. So what I do when I pull this up, I see, within 30 seconds or less, I can instantly kind of get a gauge for what the market's doing. So I see that the spot price of the VIX is going lower. At the same time, implied volatility is going lower. So what this means is options prices on the VIX are going to be very cheap. So if I wanted to buy portfolio insurance, or if I wanted to go long, the VIX by, say, buying a call option, those call options would be priced rather cheaply, right? Because we have our spot price of the VIX hovering near 1-year lows, and we have the implied volatility of the VIX also moving lower, which means options prices are getting cheaper. So I've showed, in the past sessions, what's really cool about these views. You're able to draw, right? So I can draw this relationship here between a falling, implied volatility and a falling spot price. Other things we can do, and we can draw trend lines from this view. So again, here we can look at spot price, going lower, and then we had it bumped up above the trend line. It's coming back. So what will be interesting to see is if spot price comes back and retests this trend line, or if it rebounds and heads higher. So these are the different things that I showed again in the prior videos. I just wanted to kind of briefly recap. My other favorite thing, kind of anybody that's joined these before will tell you, is I really like isolating the implied volatility of the VIX. And the reason why I like doing this is this is the equivalent of creating, a fear gauge for the fear gauge. So when I come here, other cool things we can do, we can draw our trend line. We could see kind of where the peak for the VIX's IVX has been over here, and we could see where the trough has been. So we have our support and our resistance lines that we can draw, which I always find very interesting. Let me bring that back. Again, this is the one view where you're able to draw. On our charting view, which I'm going to demonstrate for the most part today. That's not where you would draw and play Picasso, but on this view, this is where you're able to do that. And so the other thing I like to do first thing in the morning and throughout the day is I actually put the Bollinger Bands and I put the RSI on the implied volatility for the VIX here. And so what this tells me is this helps me gauge where the VIX is going to go. So, sometimes it's not about the trades we make, it's about the trades we don't make. And what I like to do when I'm trading volatility is I like to look for extremes and in the VIX's IVX, right? So here, if we look past at the last 1 year of trading for the VIX, we could see there's periodic times where we have these spikes above or below, these Bollinger Bands. And for what that tells me is when we spike above, that means implied volatility for the VIX is stretched to the upside, which typically means the VIX will retrace. And if the VIX retraces, when the VIX goes lower, the market goes higher, right? It's that inverse relationship. So I use kind of these Bollinger Bands and these RSIs to kind of gauge where the VIX is going to go. Right now, we're middle of the road, so I don't really get a clear signal from the VIX. But this is something, again, that I look at every single day just to get a quick little temperature gauge of the market. But today, I want to focus on a specific stock. And again, we used Apple. We got good feedback on using Apple in the past, charts part 1 and charts part 2. So if you look at this would be equivalent to what we just saw with the VIX. Here we have price, we have historical volatility, and we have implied volatility. And you can see kind of this beautiful uptrend that Apple had kind of for a lot of this year. This is why we've written about tech. Tech was very strong until recently when it retraced. In Apple's case, it had earnings and Wall Street, sold them off after earnings. You can see earnings came out on the 3rd, and Apple's been in a downtrend since. But what's interesting is will Apple, rebound, or will it continue lower? And we can use charts to help us gauge what trading strategy, we should create. Because if you look right now, we have Apple turning higher, yet implied volatility is still going lower. So it could be cheap to go long Apple, which is something that, we'll look at today. So again, from this view, this is where we do our markups. There's all sorts of interesting things you could do. You can make the line bold. You can make, put your arrows here. So feel free to, play with this as you desire. Once, we go offline here and you're looking at potential trades on your own. But the other things you could do is you could take a snapshot from this view, add that to your trading journal, which I do often. You can also save this layout. So that way, when you pull up a different company, say Microsoft, you can go ahead and add the layout that you like. And this question did come in from this view. In any of our charting views, you can get and view up to 5 years worth of data on spot price, implied volatility, and historical volatility. So this is a treasure trove of data, and it really clearly illustrates, when Apple's going up, when volatility is going down. When Apple is going down, volatility is going up. That's that inverse relationship that we were talking about. So the other things that I wanted to show today, with Apple is my basic thesis here, and this isn't an actual trade recommendation. This is just showing how to take this and then dive deeper, like a basic premise. And our basic premise is, Apple it's cheap to go long Apple because, we have implied volatility still going lower, yet our price is ticking higher. So if we just use that as a general working theory, I want to show the other things that we can see from this view. So I showed the charts that we had available to us in our options chain view. We have time skew, and I'm going to use the September 15th as our example for today's webinar, because I feel like, it's a month out from now, and it's a really good example that I want to use to demonstrate our charts here within IVolLive. And what we can see is, within our time skew, we're also going to look at this in our charting tab, but this is just a very easy way to access both calls and puts. And what we see is the implied volatility for this specific Apple option, and it shows us what's happening along the maturity curve. So these are options that expire in 3 days. These are 17, these are 31, and so on and so forth until we get out to 857 days from now. And what we can see is interesting. We see that implied volatility is going lower. So we just had this earnings announcement, and then Apple's been selling off, but implied volatility is going lower as we go out to the 31 days, but then we see a spike in this implied volatility. And that typically coincides with an upcoming earnings announcement. So in Apple's case, that's October 25th. So it makes sense that implied volatility starts to increase as we get closer to that earnings date. So this is one place that we showed how to look at this time skew, right? Maturity versus implied volatility. This same chart you can recreate within the charting tab. So I want to quickly go to the charting tab and show the different things that are available to us. Again, just briefly recapping what we did in our last week. We showed that for each one of these chart types, you can have 8 inputs per chart type. So in this particular case, that means you can have up to 80 inputs per chart type, right? And so, yes, thank you. And in this particular case, what we were looking at is we've been studying tech. So we have Apple as our base, as our base spot price. This is our primary underlying. And then we compared that with Microsoft, Google, Amazon, NVIDIA, and Tesla. So this is a spot price chart. We set it for 1 year. But again,
how are you doing?
You can go back as far as 5 years, and you can drill down as near term as 1 day, right? So it's up to you what you want to do on these chart types. Again, this is not the chart type where you would draw, the trend lines or add technical analysis. What the charts tab is for is when you want to pull and design a specific chart. And in this case, I wanted to see how the giant tech names were trading relative to one another. So again, from our legend here, the way to minimize this is by clicking the handy little X. If you want to get rid of a name, so if I wanted to get rid of Meta, for an example, I hit the trash can, and now Meta's been deleted. But what this tells me is how these names have been trading relative to one another over the past year in this case. And we can see that NVIDIA has gone much higher. It's taken off on the heels of that AI trend. Microsoft has done well. Then down here we have Tesla. We have Apple, which is not, risen as high or as fast. And then we have Amazon and Google. So that's a very simple chart if you want to look at an underlying spot price. Your default when you register for IVolLive will be the spot price for the S&P 500. This is the most widely followed index for our users. But again, if you wanted to add a spot price chart, this is what you would do. Now, implied volatility is also very interesting because here what we're looking at is Apple versus all these other tech names, and we're looking at the implied volatility, right? And so this tells us the different relationship between these names. And when that relationship gets out of whack, it could be an interesting trading opportunity. So if we look over here, in present day, what we have is NVIDIA has the highest implied volatility. So what that tells us is, in general, NVIDIA's options are going to be the most expensive. So if you're looking to sell options on tech names, you can get a juicy premium if you're a seller of NVIDIA. If you're a buyer of NVIDIA options, you're going to just be prepared to pay, because you could see relative to its peers, NVIDIA is expensive. If we come down here, what is our cheapest one? Our cheapest one is Apple, which is why, again, I want to use Apple throughout the course of this webinar, because I feel like it's a great illustration. But when I was preparing for the webinar and I ran these charts, I saw not only was Apple likely to at least bounce, but also that its implied volatility was low relative to its peers, meaning it'd be cheap to go long Apple. So that's what I like to use this implied volatility chart for. Not only does it show you the implied volatility for a specific name, but I like to plot it against other peers in the industry to see, okay, where should I be selling options and where should I be buying options? Where are they expensive and where are they cheap? Historical volatility, let's pull up this chart. So this is what's looking, this looks at what has already happened. So again, I plotted the same names so that way we could stay apples to apples. HV20 is at 20 trading days. HV or implied volatility, IVX30 is equivalent, right? It's for a 30 calendar month, and this is 20 trading days. So it equates to virtually the same apples to apples comparison. So just to make that note, and then we can see here, like Meta, had some giant spikes at the end of last year in its volatility. As we went into this year, Tesla, no surprise there, had some big spikes in its volatility. And again, what you're looking for here is a relationship, not only with the name and its own volatility, like for example, Tesla, we can see, has been trending lower with its historical volatility, but you're also looking at the relationship between a peer group. So again, we have Tesla that has the highest historical volatility amongst this peer group. We have NVIDIA that's clawing higher, right? Because that makes sense. Its implied volatility has been very high in recent months. And so as that implied volatility becomes historical volatility, it makes sense that this line is going higher. Here we have Meta and onwards and all the way down to Apple, our favorite for today. So let's go ahead and minimize that view. And then we have our total open interest and volume. This is another popular chart our users like to use. Again, these lines, what they symbolize is call and put volume for our peer group here. So you can see there's a giant spike in Tesla volume on this day. That was January 27th, 2023. So you could go back on a calendar and you could see what happened with Tesla on that day. It was probably an earnings announcement or some kind of lawsuit or judgment award that led to that huge spike in volume. But this is cool, a great chart, because what I use this for is I like to compare, again, amongst a peer group. This could be energy, right? This could be Exxon, Chevron, Citgo, for an example. And what I like to do is I like to compare volumes, which name within a peer group is getting the most volume. When you have these huge liquid names, there's not normally a material difference. Liquidity is there, so you'll be able to make the trade. But if you were trading more thinly traded names, this could be very interesting to compare volumes amongst that peer group. So that's how you create that chart. Moving along to some other charts that I've prepared. Here is the single contract analyzer. This is one we didn't have time to cover in charts part 2, but I did show a view of that in our from the options chain. So what this is measuring, let's go ahead and maximize this. This is a really cool chart because let me get our legend. This is showing the Apple call that I showed from the options chain, that 180 call that expires September 15th. And this is showing the 180 put. And then what we have on our y-axis is implied volatility. So what we can tell in very simple terms is we could tell that a call option all else being equal for the same strike price, a call option has higher implied volatility than the put option. So the call will be slightly more expensive than the put. And then here, what we can do is we could change the strike price, right, to any strike that we cover. 180 is at the money, which is why I have that pulled up. And then we can also change, if you remember in that table form, we were able to look at bid, ask, last price, and implied volatility for every strike that we cover within IVolLive. So this isn't just one option per stock. You can look at this data for every strike price we cover within IVolLive. So just to go back real quickly, I want to show you the tab that we had pulled up, so you can hammer this home with our Apple tab. Let me scroll to that real quick. Another teachable moment. I've got multiple tabs going within IVolLive, so I don't lose my work on any given tab. But if we come here and we scroll down to our expiration, so here we go. This is the same, essentially the same data. The difference is what I like about the single contract viewer we were just looking at is it puts call and put against each other. In this particular view, because I know somebody asked the question, it's essentially giving you the same information, the bid, the ask, the implied volatility of this strike, and then a table. So this shows, when actual trades happened in the market for any given trading day. The only difference is again, you have to decide here on whether you want to look at the call or whether you want to look at the put. What I like about the single contract analyzer is it puts those two things against each other, the call versus the put. So I instantly can tell which one has the higher implied volatility and which is going to be more expensive. So that is one topic I wanted to cover, since again we did get a question on that. The other thing we got a question on is term structure. And again, here in our Apple view, if we come to the options chain, again, a good teachable moment, we can look at our, excuse me, let me click on time skew. We can look at time skew. And what this is saying is what's happening with implied volatility as we look out on the maturity curve. Again, I showed this a few moments ago, but this is where you find it within the options chain view. This is where you find it if you want to build a term structure chart within the charts tab. But what's neat about this charts tab that's different than the options chain view I was just showing is, check this out. You can compare the term structure for an at the money option, right, which is around 180 strike. You can compare the implied volatility for a 40% out of the money put as an example. Here's all the different let me show you all the different fields. Let me minimize those. So here's all the different fields you can look at. And what you're looking to see is where's the implied volatility along these different strikes? Where is it most expensive? Where is it cheapest, right? So what this tells me here, again, let's pull our legend, in very three simple comparison data points. What this tells me is implied volatility is lowest at the money, right? But look what happens when we get out to right around 150 days, right? So this would be an option expiring in 150 days. What we find is that this 140% out of the money call option, right? So this would be something, a virtual strike of, say $248 has a lower implied volatility than the at the money call, right? So going long, if I was going long and I was looking on the expirations, I could get some cheap options if I went, 140% out of the money and I went past this expiration date. But if I went here, with 30 days out to expiration or 60 days, those are more expensive than the at the money call options. And then if I'm looking at this put, this 40% of the money put, I could tell the implied volatility is high, meaning if I wanted to sell an option on an Apple, right? If I wanted to sell a put and agree to buy it, I could get a nice premium. If I look out anywhere between 7 days and really a year on the expiration curve for Apple. So what I like to do with the term structure from this chart view that's different than the options chain view is I like to compare an at the money with an out of the money put and an out of the money call. And then I like to see where the in the money gets cheaper or expensive relative to the at the money options or out of the money options. So that's where that becomes very useful. And again, these are all the chart types that are available from this drop-down bar. So you just click term structure. So the question was, are they the same? Well, yes, they do show you from the options chain view and this chart view, they do show you the same. But from the chart view, you can manipulate and compare in a way you can't do, again, from the option chain view over here. So moving right along to another one of my favorite charts. Here is the implied volatility premium chart. So what we're looking at here is Apple's implied vol IVX30 versus its HV20. And what's important here is 0 is your dividing line, right? So when we're above 0, implied volatility is higher than historical volatility. When we're below 0, implied volatility is much lower than historical volatility. So, just as a trader, when I see this, when a point like this in November 2022, where implied volatility was so low relative to historical volatility, I'm going long options here all day long, because that means they're super cheap relative to what they typically are. So this is how I use this chart to try to time, when do I want to be buying options cheaply? And then on the other hand, when do I want to be selling options, right? When I'm at these peaks where implied volatility is much higher than historical volatility. If we look today, we are right at the dividing line, right? So it can make sense to buy or sell. We're close to 0. We're not at any kind of extreme, but still, that's important to know, right? Sometimes it's important to know when you're middle of the road. That's not always an extreme situation. So this would tell me calls and puts are both, relatively fairly priced, which is what we saw in our charts earlier. Implied volatility difference. So here we go. This is also illustrative. What I like to do is I like to compare two peers. So in this case, I'm comparing Apple and I'm comparing Microsoft. And what I like to do is I like to see when the relationship gets completely out of whack, because that kind of tells me when one is getting very expensive or maybe when one is getting very cheap. So for an example, at these points here, these peaks, we could see that Apple's implied volatility is much, much higher than Microsoft's, right? That's what this is telling us. That IV 8.33 is telling us that, Apple is trading at a significantly higher implied volatility relative to Microsoft. On the other hand, this is telling us that Apple is trading cheap compared to Microsoft, right? So again, it tells me I don't really use this to identify a specific trade per se, but what I do is I use this to see when a trading relationship is getting out of whack and where it could be interesting to look closer. So that is another one of my favorite charts. I'm going to move on to this charting tab. By the way, you can have as many of these charting tabs up as you'd like. You could see I've got 1, 2, 3, 4. I could add a fifth if I just went to this plus icon, because ultimately, if you have so many charts going with so many data points, it could get a little bit busy. That's why I have multiple charting tabs up at any given time. So this is also something that I wanted to show. I know last time we didn't show open interest. So just real quick, this is volume, excuse me. So this is call and put volume for these 4 stocks. And then beneath here, what I did is I did open interest for those 4 stocks. So that's how you would get, it's not that it's all on one chart. In this case, I prefer to have 2 separate charts. We could add Apple's open interest as well to this chart, but I like, in my case, I like to have 2 separate charts, one on top of the other. That one shows volume and then one shows open interest. So that is a question that came up from last time that I wanted to demonstrate. And then over here, our final chart type is implied volatility difference. So this is also very interesting. And what I wanted to show is I didn't want to get too far into the weeds, but basically the key takeaway from this chart that I like to do is you can see I like to compare the same stock, Apple and Apple, and then I like to compare a different time period, right? So this is 30 days IVX30. This is IVX360. So this is looking out, a year from now. And what this tells me is when a near term, right, IVX30 is expensive relative to a longer term, right, an option that expires 360 days from now. And what you can see is, again, 0 on all of these charts. Always look for 0. That's kind of your homing beacon. And when you're at these giant peaks, this is telling us that at this point in time, implied volatility was very expensive in the shorter term relative to the longer term. And then it's the opposite, over here. So again, when I see this, my trading takeaway is, okay, when longer term implied volatility is low, that's when I'm buying. If I'm buying an option, I can buy it cheaply with a longer expiration. On the other hand, if I wouldn't want to be buying a shorter term option here because it was so expensive relative to longer, I'd rather be selling shorter term options here, right? So selling puts, for an example, or selling covered calls. So as we look here, we're below zero. What this is showing us is that longer term implied volatility is a bit more expensive than the shorter term volatility. But again, we're not at any kind of significant extreme, which is also important to know, where our trading signals are. So this is IV difference, and you could see I like IV difference a lot. So here I'm comparing what was happening for short-term implied volatility, 30 days versus 1 year. Here I was comparing what was happening to 30-day, IVX at the money versus 30-day IVX with a 40% out of the money put, right? And again, I'm looking to see when, the short-term at the money option is either more expensive or more cheap relative to an out of the money put. This is relative to an out of the money call, right? So when is it cheap or expensive to go long and out of the money call, cheap or expensive to go long and out of the money put? And then here I was comparing Apple, it's short-term implied volatility, 7 days, versus, the most popular one, which is 30 days out. So you can see where, that relationships gets pretty wonky, where, something that expires in 7 days is a lot more expensive than something that expires in 30, and then vice versa. So those are all the different chart types, the 10 different chart types that are available within the tabs. Again, some of these, like single contract analyzer, term structure, and skew, you can also find here. And the other thing you can find within the options chain view that we did have a question on is the probability calculator. So it's kind of like, okay, we've done all this analysis. Options for Apple aren't expensive. They're relatively cheap. So, an Apple could turn higher and retrace as its implied volatility decreases. So how do we turn that into a trade? So one of the ones that we can look at here, again, if we just use the September 15th expiration as a marker, we could look along this options chain. And so now, okay, how do we take this chart analysis and put on an actionable trade? You have to decide which expiration you want to look at. I think the at the monies were the most interesting after looking through our different charts. And so I would be looking within these first 5 strikes. Unfortunately, IVolLive makes it easy on me because it defaults to the nearest 5 strikes. Again, depending on your trading preference, you can have just the at the money strike or just 2 strikes. I like to have 5. You can also have all. But for a stock like Apple, that's going to pull up a ton of different options. So let's just keep it simple with the 5 nearest strikes. I'm looking at calls and puts. And then our mid price is just tied to our spot price around 178. So if I look here and I say, okay, I want to go long Apple, right? I want to buy a call as an example. How can I measure my probability of success? So this is a little bit in the money, right? We're trading at 178. This is at 175. So this is going to be the delta will be high, right? It'll be sensitive to every underlying movement in Apple's price. And so if I pull up our handy probability calculator, what I want to know is, okay, what's the likelihood if I go long Apple? What's the likelihood that its price is going to be above, whatever my strike price is, right? So if I buy this 175 for $6.70, what's the chance that we're going to be above that price? So that's where you put in price 2. And then what's the chance that we'll be below whatever you want to do for price 1? I like to do a lower price for price 1 than price 2. So that's just my personal preference. So here we go. Our probability calculator within seconds spits out what this trade, the likelihood behind this trade. So if we buy this 175 call, right, and we bet on Apple turning higher, there's a 63% chance we'll be above price 2, which is 175. So far, so good, right? Because this means that there's a greater than 50% chance that Apple will be above 175 at this expiration date, which is September 15th. On the other hand, there is only a 20% chance that Apple will be below 170. So kind of the way I look at this when I'm doing this analysis is I'm saying, okay, I was just looking at premiums. They're not super cheap. They're not super expensive. It's kind of just Goldilocks right now. So, if I sold this 170 put, there's only a 20% chance that I'll get put, right? So I can keep this whole 146 premium. On the other hand, if I wanted to go long, right, and benefit from the upside in Apple, there's a 63% chance will be above 175. So this is a really good, once you do kind of the chart analysis, you want to evaluate specific strike prices. This is where you go to kind of determine the odds. What you're able to do over here on the options calculator, we'll cover in a different webinar, but basically you're able to play with different strike prices, different prices for the underlying stock, different days to expiration, different implied volatility. And as you adjust these, what also adjusts is the price for the option and all the different Greeks for the option. So I know somebody asked that. What we'll do is we'll plan a webinar where we cover these calculators in depth. But for now, what I'm interested in is two different trades. I'm interested in maybe selling this 170 put and earning this income, $145, or I'm interested in buying this 175 call and spending $6.70. But now that I know my odds, what I need to do is I need to run it through the P&L calc. And I need to say, okay, well, what does my profit, my potential profit look like? And what does my potential risk look like? And that's where the P&L calculator comes in handy. And this is how we tie all of these tools together, where we start with charts, drill our way down to calculators before putting on an actual trade. So what I would do is I would go find this specific strike. Let's start off with our September 15th. Let's start off with our call. Let's have some fun and buy the call. My Zoom bar here. All right. There we go. So in this particular case, this is how to read the P&L calculator, a very handy tool, very simple to use. So here we have everything graphically displayed. Our blue line is our break-even line. So remember, buying a call option isn't free. So just because there's a 63% chance we'll be above 175 doesn't mean it's a great trade, because we need to know where our break-even point. It's going to cost us $6.70 to get in this trade. So really, we need Apple to be, 175 plus 670, right, in order to make a profit. So that'd be, 181 and 70. So say 182. That's why this blue line is at 182. It automatically calculates your break-even point, so you don't have to, especially as trades get more complex. So that's why it's here versus 180. The other thing that you see is a table view. So this tells us, okay, if Apple goes to these following stock prices, what does our potential loss look like, right? Obviously, we'd be sitting on a loss if Apple went down. And then what does our potential profit look like based on our entry price here? So that's, again, where our break-even point is. So really, in our analysis, we need to say, well, what's the likelihood that Apple will be above, 182? At this expiration date. So let's come here to our handy probability calculator. Let's type in 182. And now we can see there's only a 37% chance Apple will be above 182. So really, it's not a great trade, because if I spend all this money and Apple doesn't go to 182, I can lose this whole, $6.70. So now let's go ahead and evaluate the other side, right? Let's go mildly bullish by selling the same expiration, but we evaluated the 170 and we evaluated the put, right? So we'd earn this $1.45. So now you can look at our P&L and we could see, all right, if Apple stays where it is or goes higher, obviously we'll earn up. Our earnings are capped by the total amount of the premium, right? 145, we can't earn any more than that. But again, this trade has a much higher probability of success, right? Because there's only a 20% chance we'd be below 170. And even if we were, we could get put and we could start selling calls, covered calls against our shares. And then we could go back to our charts and we could figure out which expiration date on the covered calls had the highest implied volatility. And then we could sell those calls to maximize our premium income. So after doing all of that analysis, this would probably be the trade that I gravitate to versus buying the call outright. And that's how we go from dashboard to IVolLive to running through our charts to then getting to our P&L and putting together an actual trade. So again, that's simple, right? It's not a real trade, but that's how all these tools work together. And that brings our 3-part chart series, I think, full circle. Again, from looking at the charts within IVolLive, adding technical analysis, saving a snapshot, and then drilling deeper with our 10 different chart types. So I'll go back here and again, show everybody how to pull up that tab. We did have some people join us a bit late in the session. So you would just hit this plus icon and then chart, add, and now I have a 6th chart tab. Your default is going to be, the SPY, and you're going to see the spot price, implied volatility, historical volatility, total open interest and volume. And then this is how you would change your charting view, depending on your favorite. In my case, I tend to like what I like to call the Big Mac view. Everything's stacked here. And then you're able to add the different charts. And then you could, for example, delete this one, and you're looking at these two. And then if you wanted to compare different things to SPY, you would just click the compare button and you could add, NDX, you could add QQQ, things like that to these charts. Or again, you can create your own, as you see fit. So I'm going to pause now, take a sip of water. Charts is always a beefy topic, and then see if we have any questions. Feel free to just type those in the chat. Also, I want to make sure everybody has, let's see, the support at IVolUtility.com for any questions, comments. We'd love to hear from you guys on these sessions, especially to evaluate what topics we should tackle in future sessions. So again, let me take a sip of water here. Thank you to our founder and CEO, Genna. He is my invaluable partner in the chat while I'm talking here. Make sure Mr. Genna was able to cover it. Yeah, excellent question on historical volatility versus implied volatility. Basically, the question was, what does it typically mean when historical volatility is greater than implied volatility and vice versa? And as Mr. Genna mentioned in the chat, what it means is high implied volatility typically means that the options are too expensive because the market expects an underlying move. And in most cases, when you see high or elevated implied volatility, the market's anticipating a downward move. That's the inverse relationship. Whereas with a lower implied volatility, that means the options market makers think the underlying price will either stabilize or go higher. Also, historical volatility, as it indicates, that looks back. That's what actually happened. Implied volatility is predicting what will happen. And obviously, as traders, we need to know, our focus is on what will happen, right? So we can capitalize on that. Great. And in our recap, again, we'll put out all 3 of these videos. And in part 1, I spent a ton of time in our IVolLive view. Part 2, I spent half the time charting and the other half of the time on half of these charts. And then today, of course, we did the other half of these charts and then brought it full circle with a P&L calc. So we'll put all 3 of those videos together for everybody as a bonus for joining us today. We'll also put the link for IVolUtility, so that way anybody that's not currently a member can set up. We do offer 7-day free trials for everybody to try and battle test this. And I encourage you, come in, take 1 or 2 of your favorite stocks, play around with the different charting methods. And then again, if you run into any issues, write to us at support@IVolUtility.com. And I hope everybody enjoyed this session. Again, charts is beefy, but popular and important topic. So thank you guys. Any feedback is always appreciated. Thank you very much, David, for the kind words. Calculator focus class. Okay. Yeah, we'll do on our next webinar. I think that's a good idea. Let's do our calculators because those are so critical and there's so much to them, but it's easy to use. It's much easier than I think people think. So that's a great question. And thank you for the good feedback.
Thank you, Jonathan.
Thank you very much. All right, guys, I think that covers everything. So again, this has been Jonathan with IVolLive. Until next time, happy trading.